You know, Joe, this is exciting. Come on. Personal income and spending. How much are we spending? How much are we earning? But I'm also interested in the advanced trade balance. At minus $86.4 billion for July, it reverses off of what was $92.1 billion in the rearview mirror, the biggest trade deficit ever. And if we look at wholesale inventories month over month, they were up 0.6. That's a little light. We need inventories. All right, here we go. If we look at personal income expecting up 0.3, we end up with a number up 1.1, up 1.1, much better than expected. And of course, if you have to go back and see when the last time we had a number this powerful was, you're going back towards March of this year. And if we look at what's going on with spending, and that probably is the most important issue, it's close. It's a little light. Up 0.3, we're expecting up 0.4. And everybody, of course, is magnifying what's going on with spending because we know that there's income and there's savings. But is the COVID variant going to slow down spending? And that's important. Now, we missed a tenth on this number, but we gained it back on the revision of last month from 1 to 1.1. All right. Now, if we look at real personal spending, taking into account inflation, it's down 0.1%, exactly as expected. All right. Now, let's get to the money ball. These are some of the Fed's most important and well looked at inflation data points. Personal consumption expenditure deflator month over month is up 0.4. Exactly as expected, 1/10 lighter than the 0.5 in the rearview mirror. Now, if we look at the deflator year over year, it's up 4.2. 4.2 is the hottest since November of 1990. Since November of 1990. And if we look at the core deflator month over month, it's up 0.3. And up 0.3 here, well, that is actually backing away a bit from last month, which was up 0.4, revised to up 0.5. And finally, the last personal consumption expenditure core deflator year over year is up 3.6%. That is the hottest since February of 1991, although there's an asterisk here because last month moved from 3.5 to 3.6. So technically, we're equal to last month, and last month was the highest since 91. 1.34, we're up 9 basis points on the week. We're down 1 basis point on the day. 1.37% is so far the high intraday yield on 10s, which matches exactly with those double bottoms in 2012 and 2016, July to be exact, that we've been talking about. And I would continue to monitor 1.37 to 1.39. If for the week we close above 1.40, there is going to be more selling pushing rates higher. My opinion, this is probably the top of rates for this particular move. I just can't see the Fed being too hawkish, even though most of our non-voters that have been on, that Steve had on yesterday, that were great interviews, of course, we're going the other way, saying it's time to really start considering a taper. Melissa, Lee, and Joe, back to you, and have a great weekend.